to this, our moderated panel session on institutional investors as debt syndicates. I think a lot of this you probably will have heard before over the course of yesterday, but for benefit of those on the internet or who weren't here yesterday, we will try to be comprehensive but of course brief as well. I think we've taken the point to mean, can you have a situation where the procuring authorities, many of the sponsors, engineering is based for something that looks like bank debt? Is there a possibility for something that isn't bank debt to maybe work and operate a bit more within the structure that all have gotten used to? And then where does that sort of stop and you draw a line and the requirements of the institutional investors really begin to dominate? So that's the theme. My name is David MacGray. I'm a London-based director in the infrastructure and government practice at PwC. And I'd like to have the panel introduce themselves.
Well, Grodzki, still at Legal and General Investment Management in London, and very keen on infrastructure, as I said today.
That's good.
Valentijn Thijssen, in Amsterdam-based APG, pension fund asset manager, and an institutional lender on the M33 road project in the Netherlands, which is scheduled to close next week, Wednesday.
Deborah Zurkow, Allianz Global Investors, which is one of the two asset managers in the Allianz group of companies.
Wieke, Hoge, lawyer at Clifford, Amsterdam-based, working in the projects group within energy and infrastructure, and recently on the M33 project in the Netherlands and the A11 in Belgium.
Miraj at ING. I work in syndicated finance, covering project finance and infrastructure across the EMEA region.
So a great representation of a bit of bank, bit of bond, and a bit of advisor as well. Certainly there's a lot of models out there, as we know. We've seen potential differences in the investor proposition from AAA, if you will, with the government acting as a monoline. That's what you get in the UK model. If the French guarantee scheme were revived, that's what the investor proposition might be. There's certainly investor proposition at A and A minus, and now potentially, two, maybe more at the BBB space. So there's variety there. And there's also a lot of variety in terms of how one might interact with the banks. Certainly in Canada and in the UK, we've had a pretty straightforward model where the banks are in there providing what is essentially a bridge to a defined cash flow event. A substantial completion payment comes in from government. They're then taken out. They might do some agency or provide some swaps or do some other things, but by and large, it is a short time limited method. That's certainly not the only way it could go, though. So maybe one way to get started is to ask the panel, perhaps provocatively, do they see themselves completely displacing banks? And if not, how would they work together with the banks? Okay, Eric, do you want to get started?
Thank you, David. Well, having just stressed how keen we are on infrastructure because we think it's a non-cyclical defensive asset class which has the duration profile which matches our pension and insurance company clients' liabilities. Having just said that, I want to pour some, not necessarily cold, but maybe chilled water on any enthusiasm before it gets carried away that we don't see any chance, even remotely, that the non-bank institutional investors can replace what banks are doing because of the fact that banks do exist for a reason. If they didn't have them, we would invent them because they have the flexibility to arrange facilities which can be drawn down or cannot be drawn down, something which just wouldn't work for us. Banks can leverage. We can't really leverage, for example, and banks can cope with early redemption, which is very difficult for us to stomach. So there's a lot in the financing space which banks are far better suited to do than we, and at the same time there's a lot which we can do in providing funds which the banks would struggle to do. So therefore there's a great case for the two sides complementing each other, and that's before you come to the point that banks just happen to have a lot of expertise, and even if they don't provide money, they can certainly provide assistant and agency services, arrangement services, and and if they're doing it well, we're even happy to pay them for that. So so therefore,
Phenomenal.
maybe. So therefore, I'm on the question of banks, friend or foe. I would say hopefully friend, but not foe. I think there's no point in antagonizing the relations.
Okay, so one end of the spectrum. Valentijn, you've just sort of lived this actually in a very real sense. Can you share a bit on why and how you worked with the banks?
Yeah, it's a bit of a boring statement, but I agree with Georg on his statement. We are not looking to replace banks. We are looking for a situation where we can optimize the use of each other's, i.e. non-bank lender, bank strength in realizing these projects. So, and that's I think what we have tried, have come close to in the N33, serves our interests, else we wouldn't have done it, of course, and it serves the bank's interests. So it's mutually beneficial, and it makes, I think, for a better DBFM future, a brighter DBFM future.
I think that's understood, and fair to say, though, it's coming from the perspective of you, I think as you said yesterday quite clearly, not at this stage being geared up, ready, willing, or able to take the construction risk. But that's certainly not the case for all investors, and I think procuring authorities, governments, sponsors, advisors can make the mistake that assuming institutional investors are a homogeneous pot, and they're just not. They're all different. Deb?
Yeah, no, and it's true that probably the product that we're able to provide to the market looks a lot like a bank loan, but absolutely would assume, as both Georg and Valentijn, that we're in this together. Certainly, if you took the collective capacity of the serious insurance and pension fund companies and gave them a reasonable percentage, you'd still probably fall short of the infrastructure needs in the OECD. So, you know, I mean, there is a place for everybody. I would go the flip side. So I would say, first of all, not only can we work with banks, but given that we are looking for the longest duration possible, there's no reason why we couldn't cede some of the earlier cash flows to banks, because that actually hits their sweet part and ours. We'd be happy to have interest only for a longer period because duration's our game. That being said, I would say the opposite's also true, which is, and it's almost unfortunate we don't have a bank, well, we do have a banker on the panel, but from the bank perspective, there still continues to be, unfortunately, as we were saying earlier, a crowding out by the banks of all of this new money that's coming in from the institutional investors. And it depends on what the bank's long-term strategy is, and if they really believe they're going to continue to have unlimited capacity. And I know it's coming from certain sectors of the banking market, but it would be good also if banks said institutional investors are our partners, even those who can still fund long-dated, because the security and stability of the market over term is that both of us coexist, and that comes from both sides wanting to cooperate.
Right. Picking up on your point about time subordination, I mean, I understand your point. Yeah, you're seeking the duration. That's well made. But what's in that for the procuring authority, say? Why would they have the bank there? If you were happy to take construction risk, which I understand that you are, and you were happy to fund from the beginning, of course, by definition, it's the same thing, what does that really do? I mean, particularly if the institutional investor in question drives the credit quality up to a point that the banks don't really value. Does that have a net cost to the public sector or a net benefit and to sponsors as well?
From my perspective, it's as long as the financial cost doesn't change, which it shouldn't, it's a net benefit to the authorities and regulators to have a variety of options in their funding toolbox. So I don't think crowding out is of any particular interest for the authorities over the term. So I'm not sure that you would look at it that way, and that I wouldn't call it subordination. It's just that the tranching over time. So to the authority, it should look exactly the same. I know we make a lot, and earlier we had a big discussion about the ratings and who needs ratings and who doesn't. Yes, there might be some differences between what the rating agencies would consider investment grade and what the banks sometimes consider investment grade, but it's kind of pinhead relative to the size of these transactions and, you know, the term. So we're talking about, is it a 1.17 coverage or a 1.2 coverage? That shouldn't be the determining factor, in my opinion, relative to working together. Do you guys agree?
Yes. Other side of the table now, Ali, you've, I think, got a product which in many cases is a hybrid, but not necessarily a hybrid in which the banks are taking the construction risk for that long. As I understand it, it's a revolver which is periodically taken out by the institutional investors, and those takeouts are pre-completion. So what do you think that product is offering both the banks and the instos, if not construction risk allocation?
Sure. David, I'll come to your point in 1 second, but I think I just wanted to pick up on a point that Deborah made, which I think is a very important one, which is this issue about banks, certain banks still out there providing long-term lending. And I think we've got an issue that we need to face up to. At the moment, the areas which are probably of most interest to institutional investors, the mature markets like Belgium, like the Netherlands, like Germany, etc., those are exactly the markets which are most overbanked. So in those particular markets, you can see this on A1, A6 and other deals, you can still get long-term lending in those markets. So the only way of addressing this is, I think, for the procurement authorities to make it more attractive in some way for bidders to try and bring in institutional investors. That's one way. And the other thing is to expand the pipeline of projects, to try and basically get to a situation where you've got such a large funding requirement that you actually have to attract new money in because the banks basically can't fulfill the needs. And that's going to be difficult given where we are in terms of austerity programs, etc. But I think that's just an important point to bear in mind. Just coming to your point about Pebble, etc. I would just, before answering that point directly, I would just break it down into two parts. I mean, the first thing is there are a multitude of different options out there. There's Hadrian's Wall, there's Pebble, there's the EIB initiative. All of these initiatives involve construction risk being taken basically by institutional investors alongside banks. And I think that we should step back for a second and maybe consider a fourth alternative, which has not been focused on hugely so far in the discussions, which is looking at the risk appetite and the expertise of banks and institutional investors. Now, I think on that point, whilst it's fair to say that some institutional investors can take construction risk, I mean, banks are staffed up, they've got teams to take construction risk. I mean, I think that there should be a bifurcation here between that part and the institutional part in terms of post-construction. And I think that what should be looked at is maybe governments providing some sort of backstop guarantee or take-out risk mitigation mechanism to banks that post-construction there is some method that we can use. Now, just on Pebble quickly, I mean, it's essentially a product where we're trying to provide credit enhancement to a piece of paper. You have an A note that's 25 years, you have a B note that's out within 10 years provided by banks. And the idea is that the banks are in there for the riskiest part, which is the construction phase and the first few years of operation, where essentially you're in the riskiest part of the transaction. That's basically how it works. Sure.
On the government backstop point, actually, I'd like to get views on that. I mean, I think one of the concerns that procuring authorities have had is ending up, as we say in English, being the meat in the sandwich, where if they take the refinancing risk, they inadvertently take back a whole bunch of project risk. They maybe don't achieve the whole life cycle costing, and the whole sort of rationale for it as a long-term contracting model does kind of go down the drain a little bit. But that said, your Canadian model, you do have situations where they do write a check at the end of construction. So if I could just ask the panelists, what do they think? Is that real? Is that fixable? Or does government perpetually give something up if they take that refinancing risk in post-construction? Georg, any views?
I'm not 100% convinced that the early stage of a project, the construction stage, should be left entirely to the banks, and the banks or the government then taking a gamble on refinancing.
Right.
I mean, you heard it from Deborah, you've heard it from others and myself. We're happy to be there right from the beginning, and all we may ask for, depending on the project, is some enhancement temporarily, ideally, which the banks can provide, the government can provide, but
or others can provide, indeed.
Others can provide, absolutely, and therefore I don't think that the situation is that bad, i.e. the willingness of non-bank institutions is so poor to take any whiff of construction risk that we have to do it in a two-stage fashion with all the uncertainty surrounding the kind of inception of stage 2. So therefore, I'd rather not wait until projects are completed. I'd rather start earning money during that phase and bring some others, third parties of whatever type on board to possibly help me feeling a little bit less uncomfortable about the possibility that there are overruns in terms of time and budget, and I still have my money working hard and earning interest. And on the question earlier, how could the institutional portion be sold, the long-dated portion be sold to the authorities in terms of what's in it for them? Yes, I mean, it's a bit of a stretched argument, because the individual local authority or NHS trust or any health trust may not think in big picture terms. That's where the ministries have to come in and say, we, from a kind of macro perspective, want a diverse landscape of infrastructure investors being attracted to this space, and therefore from a big picture perspective, it makes sense to not always go for what seems to be the easiest, the most tried and tested, and possibly also the cheapest. We want to nurture that investor base, because that investor base will hang around even through bad times. And as we know, the banks sometimes have bad times, and therefore it's an insurance against the market, the funding disappearing. So it's not easy to sell that to a health trust somewhere in the country which thinks, well, I only have one hospital to build, and if I get it funded, that's it, and I don't have to worry about a trough in the market in 3 years' time, which may cause problem for another health trust. But that's where the kind of higher up authorities have to give some steer and say it's good for the country as a whole in the long term if we don't reduce it just to, well, a shrinking number of banks, and then we're all kind of at the mercy of them being strong and willing enough to step up to the plate. Thanks, Deb.
Yeah, I would say two things, because I really agree with what Georg said. But first, to your point, I think the investors who are coming into this market recognize there are two things that you have to say up front. One is illiquidity, and the other is complexity. For both of those factors, we expect to get a premium. For the illiquidity, of course, it's built in from the get-go relative to just sort of whatever benchmarks you use. For the complexity, I think what you're seeing is institutional investors are saying we'd like to keep that premium too, and therefore we're going to hire an expertise, or we're going to outsource the expertise. And when you put them together, you're then able to go through the construction phase. I think, to Georg's point, that we're really, institutional investors are coming in here for 30-year terms. And if you say, well, we'll take out the bulk of the risk and the pricing, and then lower for the next 25 years considerably the term, that's really not the deal that I think people are looking for on the institutional investor side. The other thing is that it's not as though operational risk is distinct from construction, because a poorly built road will have an impact on the operation. So if you come in an operation period, you still have to understand what happened during construction, what it looks like. So you're going to do a lot of that work anyway. And if the construction period is properly mitigated through bonding and other structures, the fact is, I think there's a little bit of an overblown notion of the risk in construction, but there's also probably an underestimate of what the risks are in operations. And certainly from our days in the monoline, we spent a lot of time on waivers and amendments, because small things are nothing until they become a technical default, and then they accumulate and they become a bigger default. And so you're not necessarily reducing by as much as it seems the complexity because you've eliminated construction. Then I would just make one quick comment on what Georg said, because I completely agree. There is a side that particularly governments across Europe have been saying, come one, come all, institutional investors, we need you. And as we arrive on the scene, if they're not willing to make an effort to ensure that we get some part of the cake, then I think we'll all disappear again. And to your point, in 3 years, I mean, our funds are our funds and yours too. I mean, we have those funds in-house. We're not reliant on what the conditions of the market is in order for us to produce investment amounts. But, you know, we can't stick around with expensive teams for years waiting for other banks to go away. So the authorities, I think, do have to, having encouraged us to come into the market, help us get a piece of it.
A perfect time to ask Wieke that question. I mean, we certainly heard that from, well, just now, and also a bit from some of the investors yesterday, that they felt the process was not, whilst they were not asking to be favored, and that came across very clearly, they didn't necessarily feel that they were being allowed to compete on a level field. And I think I heard a bit around make whole and prepayment and spends, and I also heard a little bit around commitment, what do you need and what don't you need, and how do you compare a product that is and isn't committed. What's your experience on deals outside ours and jurisdictions and institutions not at the table? How do you think the authorities are really doing in terms of that?
Generally speaking, I think we're still in a piloting phase, I would say, where several solutions are being developed and where authorities are not certain about what solutions they would like, and the market may be not certain about what solution they would prefer. So that needs to come together, and with more certainty developing there, I think, generally speaking, just from also a procurement point perspective, there are no reasons why this couldn't work. There are just 3 simple rules. There has to be equality, there has to be transparency, and there has to be objectivity. And within this set, I think lots of solutions can be accommodated. And even, I think, hybrid solutions can be developed together. So the question, of course, is then how are we going to get that together? I think that is the main reason for, at this point in time, maybe parties not being satisfied enough that they're being listened to in procurement or tender guidelines, that their solutions are not being fully accommodated. So there is a dialogue going on, and I think, for instance, also the competitive dialogue, which is designed maybe also to discuss these financial solutions at the table, to see what is necessary, what requirements are needed, is an excellent tool actually to drive this forward. There is a risk, of course. Procedures take a long time, high transaction cost. For instance, if you ask too much solutions at the same time, you ask a consortium to develop all these solutions at the same time, that will take time. It will make or deliver extra cost. So a question for me would also be, would additional pilots be required in this respect? We have in the Netherlands, for instance, 1 pilot now with an institutional investor where Valentijn can add to how this pilot is being going for APG. But do we need more, for instance, to see where we go and to develop, I think, more satisfaction?
Of course.
Yeah. So, I mean, just to follow on from the point, I mean, I think as a banker here, I mean, I think that bankers traditionally have always focused on originate to distribute. I mean, that has been the model that we try to promote. But I actually think in this case, and I take on board the points of the colleagues on the panel, I think we have to move towards a distribute to originate model. So basically understand what the requirements are in great depth, and then try and reverse engineer exactly the right deal. Because I think it's also fair to say that not all the requirements of the institutional investor base are exactly the same. Some people require credit enhancement, some people don't, if they're very experienced. Some people need a credit rating, others don't. Some people are comfortable with construction risk, others aren't. And then that's before you get to currency issues. So there are differences of focus and of necessity between different investors. So I think to do a one-size-fits-all thing is dangerous, and therefore we as bankers have to really spend a lot of time and effort to really get to the crux of what different investors want and where there's a fit, and then work that through in supporting our bidding consortia as well to try and put the right package that will work and be attractive.
Okay, thanks. There's a couple of specific questions that we've been asked to address, and one of them is around drawdown. So I think we can all sort of understand in the context of, and someone tell me I'm wrong, please, in a public bond, it's quite challenging to have a monthly or a quarterly drawdown process because it just doesn't kind of really work. But for a private placement, I think sponsors and banks and advisors should all take note that there's maybe a little more flexibility around drawdown than there used to be. And again, we've got, I know, two potentially quite contrasting views, but a living example. I mean, Valentijn, by definition, as I understand it, as you explained yesterday as well, you're drawn in on a successful practical completion. So by definition, it's not deferred, but it is forward start. So you've therefore had to get around the idea of the market risk inherent in a giant deferred milestone, if you will. And I think, Georg, your view is quite different on that. So if I could ask you both to illustrate your thinking on how you could get comfortable with what I think is market risk.
Well, if market risk in this case is, well, we have committed last August at BAVO to the funding to be drawn upon completion. So that's 2 years from then, or almost 2 years from now then. In illiquid debt, to me, whether you, if you commit today, you put it on the books. There's no money spent yet, but the loan is on the books, and then the interest rates move. Yeah, well, that happens. So you can already incur paper gain or loss on that loan, which is not drawn yet. That's right. Investing. Yeah. If you can't stand the heat, stay out of the kitchen. And that said, the M33 is a trial project, a pilot project, as Wieke said. There we said it's better for us not to manage the loan during the construction period because we can't show the track record. We don't have a separate team that does that. That doesn't mean that we don't have the skill within the firm. I think we do have the skill, but we don't have it concentrated and we don't have a dedicated team for that. And for a single trial project, it doesn't make sense to make the investment to make sure that that's in place. So that doesn't rule out in the future that we could do it, but we are, as a pension fund, not equipped to do the same flexibility in drawdowns as a bank by nature can offer.
Okay. Thanks. Georg.
Thank you. Well, we are maybe overly strict in our adherence to the principle that there is no free lunch, but that's where we are. If we make a promise that we hold a spread or lock a spread over a meaningful period of time, then that is a very valuable promise, and that normally should be paid for. How much is it worth? Well, you have to look at what's available in the market in terms of spread options or spread futures. Not very much, but you can work it out using some formulas, which of course reflect the past volatility of credit spreads. But the fact of the matter is, if somebody wants to have assurance that in 2 months from now the euro-dollar exchange rate is 127 at which you would construct, well, you have to hedge that risk somehow, and that will cost you. And in the same way, we have to hedge the risk of spreads going up between now and, say, March, and that would cost us. So therefore, we're a little bit orthodox maybe, but we think a tendering authority has to pay for that if they want certainty over that period of time. This doesn't come for free, and if they don't want to pay for that, we can't give it to them. So it's as simple as that. We're managing other people's money, and we're trying to be responsible and prudent in doing so. We owe it to them, we think, to our life and pension policy customers.
Okay. In the M33, the forward effect was included in the price.
Okay, good. Okay.
We didn't give away anything for free.
Yeah, that's good.
Expect nothing less. Anything to add on that point? Or,
no, I think it's well made.
Yeah, I think it's very well made.
Yeah,
actually. Yeah. Okay. Then maybe in terms of of coupon. Quick show of hands. I think your fixed rate only, Deb, is that right?
That's correct.
Your linker only, Valentine?
But also fixed rate, in albeit inflation linked, but then the coupon is a fixed coupon. So
fixed
in
rate.
essence, it is a fixed rate.
Yes.
But indeed, the structure that we do is a bit different.
It's inflation rate. Okay.
My belief is that, say, 90% of the model that we've been able to develop together with the consortia and with the government on the M33 can be used in a, say, traditional fixed rate lender's perspective.
Georg, you're both, I presume, or?
Index linked or fixed rate either.
Yeah.
Of course, when you move into the world of index linked, then which index? Is it Dutch?
Yeah.
Is it a Belgium? Is it pan-European? Is it a UK price index? But inflation protection is a nice thing if you can get.
Yeah, I would just say we would really just haven't had the conversation about index link. There might be appetite, but we've got Valentine for Euro, and he's having a good time trying to source it. So.
Well, that's exactly right, isn't it? I mean, we understand the demand side, but I guess the supply side, at least in the UK, has effectively been shut off since 2006. Now, it's taken quite a while for that last sort of rump of transactions to work. And unfortunately, we haven't anyone from government on the panel, because a good question for them would be, how do you judge success in the sense of, do you want to issue what is de facto linker gilts, if we will, albeit with project risk, or do you want to issue fixed rate? And I wouldn't like to comment if I was a finance minister on the relative attractiveness of that. But I think what we're seeing is that there is demand, but there's no requirement to go one way or the other.
Well, the assurance that the N33 can provide is that it was a competitive process. The index-linked funding was compared to the bank funding options, and all three bidders that were offered index-linked loans by us, in the end, said that they preferred the index-linked function because it, in the end, for them led to a lower NPV. So cheaper is not the word I would like to use, but in the end, it led to it was competitive. It led to a lower NPV. So if you take the short-sighted approach of evaluating just on NPV, then we can assure parties that that's possible, that other than bank debt providers can be competitive. And as Deborah made the point earlier, if procuring authorities, consortia, etc., think it's a good strategy to rely on an ever-diminishing number of banks to be their funding sources, they might. In the Dutch proverb is "het schip keert de wal." In the end, you run up to the impossible of getting more funding. So diversification of funding sources might be a very sensible strategy, and as Georg pointed out, probably not for each individual borrower that is an important issue, but for the policymakers, the ministries, etc., that might be a very sensible element to put into their thinking.
Yeah, I mean, just to follow on from Valentine's point, I think that's right. Diversity of funding sources are very important. But I also think it's important to remember that there are three factors that people normally consider, which is obviously the strength of the sponsor group, the country this is in, and the size of the project. So the larger projects, which can't be bank financed, and I've made the point before about bank financing still being there for certain sponsor groups, I think on those ones, there could be additional pressure to diversify the funding base because just banks won't be able to fund the whole thing themselves. I think that's a key thing. And I think it will also depend on sponsor group because some of the very, very strong sponsor groups can still probably get away if they've got a German link or they've got this or that link that appeals. They could probably still get away, but it will vary. So if you've got multiple bidders for a project, not everyone is going to be able to attract the same liquidity pool from banks. So I think this will become more and more of a feature going forward, and I think diversity of funding sources is the way it's got to go.
Well, I think for APG, for me personally, and I'm happy to ask the question to Deborah and Georg as well, diversity of funding sources doesn't mean picking up whatever slack banks don't want to fund anymore.
It's not about not wanting to fund. I don't think it's about not wanting to fund. My point more was the size of the project is important. And I also think the sponsor group, I mean, certain sponsor groups are going to always attract more liquidity than others. I mean, that's something that we as banks have to suffer with as well.
But
if that implicitly means that only the riskier projects, the spoils, if you like, remain for the non-bank lenders, then pretty soon there won't be any non-bank lenders left.
No, I think it's important to make the distinction between banks that have certain very strong sponsor relationships with certain sponsors and banks that don't. So, for example, if you're dealing with a top-flight German sponsor, they're going to have a very strong German banking relationships. That's not going to be the case for certain other sponsors. So, we as a bank are in exactly the same position. That we have to pick our battles as well. So if we don't have a stronger relationship with a certain sponsor, we're not in the business of long-term lending anyway at ING. We try and restrict it now because that's the way we want to go. So I mean I accept your broad thrust of your point, but not completely, in the sense that there will always be those anomalies out there, and we all just have to deal with them.
And it's a competitive process.
Of course it
in the
is,
end.
exactly.
Oh, and it should be, but competition is not only the short-sighted MPV. It's also about the strategy, as Georg put out, on a higher level, macroeconomic maybe. So there should be other factors involved.
But then the only way of getting around that is for the pricing to be compelling, as you said, Valentijn, yourself. Because if you're a strong sponsor group and you're getting cheap bank financing long term with no problems, IEP is an example in the UK. This deal that was done. I mean, a huge deal, 850 million commercial tranche, very strong Japanese link with Hitachi, Japanese banks all over it. I mean, if they're going to get
kind of a corporate deal, though.
Well, yes and no. I mean, you're still getting, it's still long-term debt. It's still, there's a PF element to it. Same could be seen in Thameslink. We'll have to see. So all I'm saying is that the proposition has to be compelling for the investor. Otherwise, it's not going to happen.
So did I see a floor question, if I may? Rob.
Well, it's just going to ask, I think Valentine's point possibly goes to the heart of the issue, which is that on the one hand you've had presumably quite a long competitive dialogue process, and as your earlier point said, to accommodate innovation you need to change existing structures, and that can only work through a negotiation process. But presumably that, as a scalable business model for yourself, Deborah, and as an approach to the public sector, that's hugely inefficient for a sort of long-term way of doing business. And therefore, presumably at some point, there has to be some kind of clarity on what solution is going to win in what given set of circumstances, and how the public sector can analyse different approaches in a repeatable fashion to make that process efficient on a deal-by-deal basis. And those two requirements seem to directly compete with each other. So I was just wondering, but although you said you don't want to be left with the dregs, there's a price for everything. I mean, maybe it is that your price for the dregs is a better all-in proposition for you. But if not, then how do you ever square that circle of an efficient procurement system?
Well, appealing to a bit broader view than just the MPV. Although I fully agree that it needs to be competitive. It needs to be a good offer. We're not suggesting that we allow a lower efficiency, a higher cost to the government or the taxpayer, etc. But I'm saying even if it takes a bit more effort, if it's not as easy as a full bank solution, it might be very wise strategy to take a bit bumpier road to include some new investors to the process.
Yeah, I mean, in a way, if you think about it, Rob, this conversation is part of what you would call squaring the circle. The market is moving quickly. We're trying different solutions. These conversations, I think, if we'd had this conversation 3 months ago, it still would have been about, will the investors really come? Now, actually, we're up here at table saying, and we're here, and now how do we make sure we get involved? So the conversation is evolving relatively quickly, and I think that we probably have to have this continual revisit because the investor market is becoming more experienced and more online. So as a result, I think we have to be collectively energetic, or rather we can't be lazy and say that the answer of yesterday is going to be the answer of even today. So that's the first thing. And I guess to put Valentine's point in another way, if you're looking at qualitative factors, and this is certainly true in the U.S. market, that there's a lot to be said for putting local investment in the hands of residents, of citizens, of taxpayers. And if you do that by way of life insurance policies and pension funds, there is a qualitative factor about investing in your infrastructure that probably is positive at the same time that you are increasing the investment yields that, every one of our clients, ultimate clients, are trying to produce. So there is an economic net positive to ensuring that the investments go in the hands of pension funds and insurance companies, but I don't think it's one that we know quite how to measure yet.
Do you see in sort of a year or two's time, or not what time frame, will there be a point where we can look at the deal, as everybody can look at the deal and say, yeah, it's probably going to be a monoline deal, we'll be able to look at the deal and say it's probably going to be an Allianz deal?
My immediate reaction would be to go back to the point, every deal will be competitive, solutions are evolving, and because it's a dialogue, I don't think you'll ever really be able to, that's my view, I don't think you'll be able to do that immediately because, to Ali's point, it'll be dependent on the size of the transaction. How many solutions do you want? It might be that, on a deal that you thought was going to be a monoline deal, that the government turns out that they're very willing to waive some part of the procurement process that makes it more of a legal and general deal. So no, I don't see that happening, but I don't think that it's necessary. Personally.
It might be necessary from a sponsor perspective if they're trying to, unless we do a bit of that.
Personally, I don't see any sponsors. I don't know how many are in the room, so they can answer for themselves, but I don't see any of them not exploring every possible option to see what's the most economic way of funding their deal. So even if you had a gut reaction, this is a deal for APG, they're still going to call Ali and say, what can you do on the banking side? Because you can't afford to leave aside what might be the more competitive funding choice. So even if we knew instinctively what it is, I think you'll still want to have competition in the market.
Craig, on the back of that, David, there's more financing solutions available in this competitive process. You go to one, you go to two, you go to... Somewhat greases the wheels of the whole process. Hopefully it just means deal flow, means things getting built, means generating approval. Does it speed up the process, having more options like this? Or is there a threat that it will further slow it down? Because that's a particularly crippling point involved.
Perhaps let's give the panel the option to answer first. And Wieke, why don't you give it a go? Yeah.
I think indeed there is a risk that multiple solutions being asked from a procuring authority at the same time will indeed decrease the efficiency of the process. Yet, whilst going further and the market being developing at this moment in time, investors speaking out, banks speaking out what their possibilities and opportunities still are, I think in the dialogue with the authorities there can be still efficient solutions, but currently there seems to be a momentum where I think people need to speak out what their requirements are, put them on the table, and then that's the lawyer's job, write them down and make sure that every solution in a competitive process is being awarded and can be also evaluated on an equal basis. But that takes some time still, I think, to get there. That's fair enough to say.
That's quite fair.
Yeah, I would echo that completely. I mean, I think at the moment it's right and proper that there are a multitude of solutions out there. I see that as a great strength. And I see that as just part of the evolutionary and innovation process, which is to be welcomed. And I think that over time, what we have to move towards, and I focus on what the last questioner was also referring to, is over time we want to move towards a sort of private placement market where you get one or two institutional investors into a much more standardized situation where people feel confident that this is going to be distributed to a much wider market in a sort of a bond type fashion. I think that that's where we ultimately want to migrate to over time. But I think at this stage it's going to take a long time, and people are teasing out different options, and that will make it more complex and lengthy. But the only way of getting around that is to start earlier in the process. Start talking to the investors earlier. Start talking to the bidders way before the BAFO submission deadline, and that's just something that we have to work around.
The truth is, if you look at the real estate market, as perhaps an available analogy, over time as it evolves, it'll be lots of different things. Because I'm not sure that I'm not sure that all transactions will evolve to a state where it can be commoditized.
That's true.
Some will, some won't. PFI is probably more susceptible than some of the other kinds of infrastructure financing because there does tend to be a general sort of framework for it, but it may not be desirable either. So, yeah.
One point, if we could pick up maybe, is redemption. So certainly in...
Is that philosophic or financial?
I'm pleased you would even consider the possibilities there. I think that's wonderful. To the prosaic then. Certainly in the UK, there was an aspiration of having half of the margin added back as modified spends. The reality was that was kind of 20 bips, but that was in a world of kind of 60-point margins. Here we're in a much, much richer world, and yet the public sector, I would guess, would still attach policy value to the ability to exit transactions. But we did hear from another panelist yesterday that, in his view, spends and one or two way break was a material pricing decision for investors, which I can certainly understand. What do you think the best bet is? Should the government just say, this is what we need for spends or modified spends, please would you price it? Or should they drop it all together? Or are you willing to go further than the government has asked for to date?
Well, maybe I should step back a little. Where is this insistence or this strong preference for a rigid amortization profile coming from? It's coming from the regulators' insistence that long-dated liabilities need long-dated assets, and if they are not long-dated because of call options or early redemption options, then there is an investment risk, and therefore that has to be somewhat underpinned with equity. So it makes it more expensive for us to hold assets which are coming with early redemption or other flexibility for the borrower. So this is, I think, plain economic sense, which we don't want to challenge, and we don't want to take that risk. We don't want the regulators to soften the rules because they are very rational. And strictly speaking, one could even argue that even spends is too risky, despite the fact that it's expensive for the borrower, because as far as Solvency II reads at the moment, there should be no optionality for the borrower, regardless of whether it's paid for. We assume that the FSA will take a pragmatic stance and give us the duration recognition, even though there is optionality, if that optionality is coming with spends, which should go quite a way to compensate for the reinvestment risk. But it's a bit of an unknown territory, let me say that. So that's where we are coming from. Our hands are tied, not just by the regulators, as I said, but also by economic logic here. And therefore, we don't really have much flexibility, nor do our peers in the market have. Given that interest rates are very low and spreads are obviously not as low as they used to be, but the all-in funding costs are relatively low, we would say that it's not that much to ask for from the procuring authorities, because how likely is it that at some future point in time they find cheaper funding elsewhere? That's just a general point, but I would say the economic benefit of that early redemption option for government authorities is I don't think is very high. So I don't think that should be a deal breaker from their perspective, but it would be a deal breaker from our perspective if our stance does not get accepted.
You know, I jokingly said philosophic and financial, but actually it is a real factor in this discussion, because I think part of it also is kind of a principle of fairness. You know, we're going in there for long-term liabilities. We're trying to make concessions, make our products accessible to sponsors. And the quid pro quo is that we're assuring our policyholders and pensioners that they're going to get a certain return, right? And so the idea that we've made all that commitment and effort, and then afterwards, because somebody gets a better deal 5 years from now when we've taken all the risk in today's market, actually doesn't even really quite feel fair. So it's not a lot to ask. It makes an economic sense, and I think as a matter of principle probably makes sense too.
I think it's quite interesting that you've both answered the question in economic frames, which makes absolute sense. I'm not sure that's what the government had in mind when they put it out there. They weren't necessarily saying, oh, gee, I can shave a few bips, I can do this, I can do, because it's actually not within their gift. It's, you know, sponsors to do the refi. I think the government has looked at it from the perspective of saying, oh dear, I need to exit. I need to retain flexibility, a word we've heard much in the UK, and I need to exit. And I'm not sure that a few bips actually really helps them with the headlines, to be fair. But I think that for them there is almost an unvalued need to be perceived to exit. Now, I think what you're saying, Georg, is even with full spends, gee, you might not even get there if you don't get the duration match. If you do get the duration match, how far down that slippery slope can you go in terms of yielding a chunk of the margin before the FSA, you know, pulls away and says, we're sorry, we're not giving you the duration match, if I use the correct technical terms.
To be discovered. I think we assume that up to 49 or 50 basis points we're safe, but we may find out to our disappointment that this is not the case. So hard to say. I mean, I was making this remark earlier that there is no free lunch, but flexibility is not free. I mean, if you want to retain flexibility, it comes at a price. You know, if you book a rental car or a hotel and you want the flexibility to cancel, usually you have to pay the rate is higher than if you basically make a firm commitment that there is no cancellation. So that's just economic reality, and I think the procuring authorities, if they were investors, I don't think they would look at it any differently.
Thank you for that.
I think in our firm, indeed, the option of flexibility is an option, and if we would propose to the investment committee a loan with this flexibility option, the investment committee would ask, what's the price of the option and where is it?
Yeah.
So the other way to look at it is saying, no, we will not treat this as an option. We will treat it as a future or forward contract, if you like. So we say, if we incur a reinvestment loss, we want to be compensated in present value terms. They're taking away the benefit of early redemption, but as you said, that might not be the driver for the government. If the driver is the flexibility, then what's the problem? If the driver is, as was maybe for certain sponsors, to be able to book this gain because of refinancing, and yesterday was a speaker that said, well, if you look at it after cost, there's no gain. But anyways, we'll refrain from that discussion. So if the driver is, we want to have an option for future gain, then pay the premium. If the driver is purely, I want this flexibility, you can have the flexibility, but you cannot have the gain.
Okay, thanks very much.
You could potentially even say that banks are charging for that option in their upfront fee.
Oh, is that, yeah.
Well, I mean, to be honest with you, controversial stuff. I was just going to say that how refreshing it is, ladies and gentlemen, to hear people speaking sense for a change. Because banks, I think, are their own worst enemy. I mean, we've never priced in this optionality, which I've always found completely bizarre, actually. And in fact, our motivation has been quite the reverse, with margin step-ups and cash sweeps. So maybe that's why we never price it in, but I've always found it very odd that, I mean, I used to cover real estate, and when I started covering infra, I mean, in real estate, we always charge prepayment penalties. Came into infra, we never do. It's like, what's going on? So I think it's perfectly rational.
Yeah, actually, I got a lot of questions yesterday about, well, why do you think you can get it when the banks haven't? Why haven't the banks gotten it? And I think it goes back to Georg's point, which is somebody once said to me, don't ever negotiate a deal you can't walk away from. It's nice. It's a nice thought. We were really in that situation, I think, on some kind of spend yield protection or other. Institutional investors, to Georg's point, probably have to walk because it's just not what we're promising. So, you know, it makes us probably better negotiators with respect to the requirement because we don't really have any choice.
Okay. We call relationship banking a polite term for calling ourselves mugs.
Well, on that, we've just got about 2 or 3 minutes left to go. We've been very fortunate to get questions throughout the presentation, so thank you. But the last couple of minutes, are there any other questions from the floor that people would like to ask? One more.
Just on the slightly different theme, but it came up a few occasions on construction phase, construction risk. And I mean, we at Mott's spend a lot of time with clients and prospective clients, current investors, prospective investors, really trying to qualify and quantify what is construction risk, actually what the implications. Now, appreciating it's very different country to country, sector to sector, technology player to player, whatever. But I'm really encouraged, like Deb made the point about, you know, taking that balance view about construction and operations. I mean, there is risk later on. I think the PFI model in the UK, I think you and colleagues and yourself did a study for the Audit Commission and NAO, which identified that where projects really go wrong, it's actually more often operations. That's one such area, just like PFI in the UK. But I'd be interested just in some very quick views for maybe sponsors, developers in the room. There's some sat down, some standing up. Just on what is it that they and we, as technically minded people, can do more of materially or from a presentational point of view to further assist and facilitate entry into the construction phase. Some are there, clearly. My feeling is more will get there. Is it a huge shift, or are there some small pieces that will fall into place?
My blunt view is that the people who've taken on monoline staff are happy to take it, and some of the smaller ones haven't, but I'm sure the delineation is not quite so bright as that. Comments?
I thought we were maybe looking for in part views from
sponsors and developers.
sponsors, were you not?
Yeah. I'm not sure who was asking the question, but just walking around my head.
I think to answer your question simply, experienced investors will be looking for the same kinds of due diligence as a bank would be. And I think probably have the same concerns that any of your banks would be, which is, who is it who's conducting the due diligence? What did they use? Do we know them? Are we comfortable with them? So I'm not sure much more needs to be done. Of course, the rubber meets the road on how much surety you have or what's a construction package. And on that level, it's probably the case that institutional investors may be more conservative than some of the banks. That probably is a combination of our, sort of credit perspective as well as, the relationships that people have talked about earlier. So there may be some difference in that, and I don't think there's anything that you can do about it other than choose that as part of the many factors that will determine what's the most competitive funding.
But do you feel that it's a bit of a almost untrue or inconvenient myth that installs just don't take construction risk? I mean, that's certainly where we were.
Inconvenient is very definitely the word, yeah. I think you're absolutely right, and it goes back to these conversations are part of the market evolution because construction does add a lot of complexity, and I think maybe it's become, so people have decided that the complexity is such that they can't enter into it, and the more we can help to demystify, maybe that is part of what you can do. I mean, I know that I saw one construction company the other day put out a series of slides where they showed, the projects they delivered on time and on budget, because of course a lot of construction companies, that's part of what's, internally known. There isn't much knowledge about, do things really go wrong in construction? Is that a risk for the construction company? Does that mean that actually, they're going to do this deal with me and the other deal with me is not going to work because they've overrun costs? So you might be able to publish more information about how the projects have gone historically that could be helpful.
Right, lest we tarnish the overrun reputation of PPP by continuing to overrun more than 2 minutes, I think we'll call it there. Thank you all very much for your attention, participation, and kind listening.
Thank you.